Hey, welcome back into the podcast. Coming live before Thanksgiving here, give you a little market update. We have one of our admired contributors, Brian Cushing with Guild Mortgage. How you doing?
I'm good.
Having some fun today. We're in the executive chairs.
Yeah.
We're trying these out. I've seen these in the corner of his office for a while, so we're in the executive chairs, so watch out. So we're gonna give a market update for October. From the Reno Sparks Association Realtors, go over the numbers, talk about the crazy market that we're in and how it's changing. And then you're gonna wanna stick around to the end because we have some great alternatives, the top 4 alternatives for financing options right now in this crazy market. So we're gonna look at some other opportunities besides the conventional way to get into a property right now because times are tough when interest rates are around 7. Right, Brian?
Yep. Your creativity is created when things get difficult, right. And that's where we're at.
And we're gonna just kind of go over those. So stick around. So we're gonna spend a couple minutes, go over the market numbers. I'll go first, Brian. So median home price for the Reno Sparks area, and these are supposed to be homes that are resale homes, and there are a few homes just because they got listed on MLS that are new, but generally speaking, it's $540,000. Believe it or not, that's a 0% increase year over year. So we're not on an upward trajectory.
That's higher than projected before, though, right?
That's right, and I did lose a bet. So I lost lunch. I thought it would be lower than 540, but it came in a little bit, and it's up about 2% month over month. So that's what's going on for median home price.
Cool. Yeah. Thanks for lunch, by the way.
Yeah.
So closed sales, 372 closings. That is down. So 34.7% less than October 2021. That's how many less homes are closing in the month of October. I think that's down 22%, almost 22% from month over month. So definitely a slowdown. We have the fall and winter slowdown in Northern Nevada in full swing right now.
Well, just like we're talking about today, the office is empty. People are taking time off this time of year. So what I'm seeing that I didn't see in years past, the last 2 years when we had this huge run up, is that we're getting back to a seasonal market. So Northern Nevada, it's cold, high of 35. We have Thanksgiving tomorrow. People are taking time off. So we're gonna fall more into that seasonal pattern where the hot time is spring to late summer, and then we cool off in the fall.
I think they call that a traditional market.
Traditional market, yes, which is kind of nice in the sense. Median days to contract. So when a house gets in escrow and they get an accepted offer, we're looking at 36 days. It's when it's listed to when it gets in contract. That's what that is. Sorry, I was off a little bit on that. So it's 36 days. So if you list your house about a month ago, the median home price or the median priced home gets into contract about 36 days. And that's up almost 340%. Wow. So, I mean, a year ago, pretty much you put your house on a Friday, you'd be in contract on probably Saturday, but most cases Monday.
Well, if you sold a house in 2021, congratulations, because you sold it in 4 or 5 days.
Yep. We're moving into a more traditional market. And what we're seeing, if you look back through the history of our area, most houses are on the market between 50 and 75 days. So we're still low. 36 is still low. So
it's still, I guess, technically a seller's market in a sense.
It is, believe it or not.
I guess if you're asking the right price, it's a seller's market.
Yep. And then we did some research. So we've talked about on this podcast quite a bit. The next stat is list price received, 98%. And Brian and I kind of looked at each other weird. We've gotten a lot of comments from our viewers, calls, and direct messages saying, how in the heck are people getting 98% of what they're asked? So what do we find out?
List price received of last asked price.
Right. So if you reduce the price.
Yeah, so you drop your price 50 grand.
To we'll start at 700,000.
Okay.
Didn't get any offers. We dropped it down to 650 and then we got offers.
And the offer was 640.
Yes, so they're getting 98% of the last ask. It's not the original. So with that being said, right now what we're seeing, just looking at the map here from the RSAR Market Insights, it's about For 2022, so far through this year, it's 32% of the homes are getting above
the last ask price.
Last ask price. So we're probably not going to cover that anymore because I think that's a misleading indicator on this. And
maybe for November you could get the real stats of what the actual original ask price to their final close price.
Well, don't you think that would be more helpful?
I think that'd be great.
Maybe we can talk to the association and get that number because that'd be.
So we'll address that when if we can get the information, we'll address.
But
that.
It's not whatever the original. We're not getting 98% of what the original list price was. So
amen. Because I would have to agree.
Go for price per square foot. What are we looking at?
$304 per square foot. Another stat that's a good one as a rule of thumb. Basically we're $300 a square foot if you just want to price your house generally.
Yeah, and that's for the median price. So
yeah,
and it's a good one. What I use that stat for, and it's good for, in my opinion, is if you're looking across the country. Yeah. If you're just trying to figure out where we're area. Yeah, if you're new to the area, what is the price per square foot cost here? Yeah. But I'm here to tell you, and we talk about this a lot, is it really varies between neighborhoods and even street by street. So
well, and it's interesting too because over time it's been it's about 1% down from a year ago, but 1% higher than a month ago.
Right. So it's pretty steady. Yeah. So a house is going to cost you around here on average, if you're looking for
$540,000 house,
is 300 a square foot. So new listings. So we're getting squeezed on new listings, and that has something to do with the seasonality of our market. New listings, 420. That's down 32% year over year and down 23%. So I would expect the down 23% because from September, October it gets colder. We're getting into fall. What I don't expect is down 32%. That's a huge drop off.
Well, it's like the closed sales too. That was down 35% from last year at 372 closings. So if you sold 372 homes, but only 420 came online, you only gained 50 roughly on the total inventory that's out there.
The whole inventory.
Right? So that in and of itself is pretty healthy and pretty supportive of a real estate market that's not in free fall in any stretch of the imagination.
Right. So what about active inventory?
1,265 homes are active for sale at the end of October.
And that's up a lot.
104% since last year. Okay. But actually down month over month, right? 9.5% lower because some people's listings from 6 months prior fell off the market. So if you put your home on the market like April, in the spring, let's say, and you had it at a high listing price and you were caught off guard with the change in the market and you weren't willing to drop your price so low that you could, get a buyer in the current atmosphere, then that home's no longer listed for sale. And so net 1,265 homes.
Yeah, so we're seeing, we work a lot. We're living in South Reno realtors. We're seeing a lot of houses go off the market. So they've been on the market 4 or 5 months, not getting any action. And I think a lot of people are phoning it in for the holidays in the sense that they're saying, well, we'll put it back on the market when there's more people looking. Because seasonally right now, people aren't looking.
Well, I even had a friend of mine reach out and he had his home listed. I knew he was building a new home. He's still living in the home that he's trying to sell. He doesn't have to sell it. He wants to sell it, but he also doesn't want to have people coming through the house during the holidays. So if he doesn't get it sold by November 30th, he said he was taking it off the market and he plans to put it right back on the market in January. Or I want to say he wanted to put it on the market when it became a new listing again. So how long does it have to take? 30 days off the market and it's new from that perspective?
Yeah, I don't know the rules on that, and they change all the time. But yeah, I mean, it's new. I think it becomes new once it switches, but we can take a look into that. But yeah, but a lot of people are saying, and I have some, if we don't sell it by a certain date, we're going to wait till spring.
I'll put my Christmas lights up and just
enjoy the house and wait for the market to kind of rebound. So
unless you don't live there, I guess if you don't live there, you don't care. You can leave.
Right. And then this kind of brings us down to the month's supply of inventory. Rule of thumb for our area is a balanced market, which means that there is an even supply of houses for buyers to buy, is between 4 and 7%. And we're still months of inventory, and we're still down at 3.4. It is up 200%. So we're seeing the interest rates, which the Fed exactly wants, cooling off things, and we're up 15% month over month. So
I think the Fed's word was pain. they're going to cause some pain, and they've accomplished that.
Yeah, it's hard to, and we've talked about this a lot, and that's why we're in the next topic. It's a perfect segue into our next one. But it's really hard to afford a house at 7%, especially when everyone is used to, it's like a drug addict rate. You're used to 2%, 3%, and within a short period of time, it ramps up to 7%. What are rates today, by the way?
They're down to 6.5.
So 6.5 is a nice improvement.
Yeah. So after this last month of consumer price index and some of the inflation figures showing a downward move, we within 2 weeks had a 0.5% drop in interest rates, which is a step in the right direction. Still more than double than
from
a year
January,
ago.
yeah.
So yeah, it's still painful.
Right. And then what's your crystal ball say about what the Fed's going to do here? Is he raising it 3/4, half?
Oh, they'll raise it again in December.
By what?
Probably will raise it 50 basis points or 0.5%. So their target is to get the federal funds rate from 4% where it sits today to 5. So they'll probably get there over the next 3 or 4 months by going up 50 basis points in December, maybe 25 basis points in January and February. And so by the end of March, effectively, we could be at 5% on the federal funds rate, which does not translate to mortgage rates.
That's what money is. Each lender's
your home equity line of credit would be based on that. Your credit
the
cards,
money that the banks lend, right? That's what the Fed funds rate is, or what is the Fed funds rate?
The Fed's fund rate is the rate that they lend to each other from 5 p.m. So basically from the end of one business day to the following day, banks make loans to themselves, to each other, I should say. So Chase Bank might lend it to another bank, and they're basing their funds based on the federal funds rate. That's how they start their.
That's why we have Brian on. He loves to talk about this stuff. And Mortgage Insider.
Mortgage Insider.
Yeah, follow him on that. He does a weekly podcast and all this. But that's why we kind of bring him in. I know it's a little bit in depth, but the more you know about the market, and this kind of helps people figure out, hey, if we're hopefully inflation's going to slow down, maybe it might be a better time to sell your house 6 months from now.
I think probably the biggest thing to know is that inflation has likely peaked, and the Federal Reserve is waiting for confirmation. It's going to take a couple more months for them to see that inflation is systematically coming down in a multi-month, like call it 3 months in a row. We have 1 to 2 solid months of slightly lower inflation. So if that continues for 3 or 4 months, by first quarter of 2023, we could see a turnaround.
Yeah, and that can improve rates, and then that will get the market going again.
It could get buyers off the fence, and they could go buy some of these homes, because come spring, I think there'll be a few more listings than there are this month.
Yep, that's true. So that's the market for October. And like I said, in about 10 days, we'll have new, and we'll come back in and talk about that, keep you informed. But now what we're going to talk about is what everyone's waiting for. And we're bringing Brian in specifically to talk about alternative ways to get finance in this crazy market, because 6.5 mortgage, 30-year fixed is tough to get. So we did some research, and we're coming up with 4 alternatives. So the first one is, you got to think outside the box when things get tough. Assumable mortgages, and I'm talking about, first of all, what is an assumable mortgage, and what mortgages can be assumed?
Okay. An assumable mortgage means whoever holds the loan, so let's say you own a home right now, if you did a loan through like a government-backed loan, a great example would be a VA home loan or an FHA home loan, are both backed by the federal government. One's backed by the Veterans Administration, the other one's the Federal Housing Administration. Those loans are assumable. It means a buyer can come along and qualify with the lender, the servicer that maintains the loan now. So there's your key, is you don't call
necessarily Ryan.
You can't call me. I mean, you can call me and I can talk to you about how to go about it. But really you have to contact the current owner's loan servicer. Yep. It's not the original.
It's whoever it is.
Yeah, and it could transfer while you're trying to buy the house. It could be transferred. So they are going through. They take a solid 90 days. This should be the expectation. And you have to qualify for taking over the existing loan balance.
Yeah, so, and this is important. The 2 things I want to point out, especially if you're a VA or an FHA person, or particularly VA, is if you bought the house, because some of these people bought this at a good rate, right? They bought the house at $300 and now it's worth $500, but their balance is worth $275. Mm-hmm. So what happens then?
You can take over the $275 balance.
Right, but you have to buy down to the $275. You buy at $5, you got to bring in the difference, correct?
Yeah, you're putting a down payment to, if you're agreeing at say a $500,000 purchase price, then you're going to put $225,000 down, so you can take over the remaining $275,000 loan at let's just say it's at 3% interest rate, which is half as much, if not more than half of what you could.
But that can be a heavy lift, right? I mean, if you're, people have 225,000.
Unless you have independently wealthy or you sold
You hit the
another
lottery.
home.
Right, so it's not easy, but it's out there. And I came across one that was actually, the difference was only about 100,000 just recently in Gardnerville.
I talked to an agent this week that had one that was finally signing the paperwork. I've been checking on them because one of my homeowners owns a house nearby, and it's a rural area, so there was no comparable sales. So we identified this home as for sale for a really long time, and I talked to the agent. He told me that the buyer was assuming the loan. So I stayed in touch with him, and it's been almost 90 days that I've been chatting with him. He recognizes my number every time I call now, and it's proceeding.
Yeah, so, and then the other thing is, if you're a veteran, be careful, because why?
So if you're a veteran and you have qualified for a veteran's home loan, so
VA.
You served our country, so thank you.
Yep.
You have the best loan option that there is, in my opinion, is the veteran's home loan. If you sell your home and let somebody assume your loan, if they're another veteran, they can take their VA benefit and they can apply their VA benefits to that loan. You can choose to sell your home and let a buyer, non-VA, assume your loan, and you will not have your VA benefits for another VA home loan until that loan gets paid off.
Yeah, so be careful that you're a veteran. Make sure you're doing your due diligence, because you don't want to be stuck with someone else hanging on to your benefit until that mortgage is gone 20 years from now.
Now, if you sold your house and you have a few $100,000 down and you don't need the VA home loan right away, that could be a great way to get your home sold.
All right, so option number 2.
Okay.
It's not one that is working right now because rates are inverted, meaning that the 5-year is more than the 10-year and the 2 years more than the 10, but ARMs. So I did have a customer 3 months ago, 10-year ARM at 4%. So that's an option, but tell me a little bit more about what does the ARM stand for and how does it work?
An ARM is an adjustable rate mortgage, and in some, if you owned a home in 2005, 2006,
be careful.
You might have had an ARM, and some people feel like it's a 4-letter word, and it can be very scary. It can also be a huge benefit. So you're locking in a fixed term for a shorter period of time than the 30 years that you're loaning.
3, 5, 7 are
3,
typical.
5, 7. Actually, I don't think 3 is even around anymore. 5, 7, 10 is the most popular.
Our customer did a 10 at 4%.
Yeah, and typically I see that in the jumbo or non-conforming loan amounts. So if you're going to borrow $1 million, say, an ARM very well might give you a substantial break in the interest rate to take a 7-year fixed period. So you need to have a plan. Is your plan to sell the home? You're not guaranteed that it's going to be worth refinancing in the next 7 years, but it might be. So if your plan is to sell the home within 5 years and you had a 7-year ARM, you've got a 2-year layover after the original plan of 5 years. If it went long, you're protected against the adjustable rate. The rate will adjust after your fixed period ends.
Right. So be careful. You still have to be able to afford it. And yeah, you just got to be very careful, because a lot of people, particularly in the crash of 2006, 7, got caught. And then we went into a cycle where home prices went down 50%, 60%.
2 and 3 year ARMs had a prepayment penalty, and most loans don't have a prepayment penalty. So don't sign up for a loan that makes you pay off, or pay an extra fee to pay off early. If you can get an ARM and have no prepayment penalty, you can just refinance it in a couple of years if the opportunity comes along, or sell the house.
But you have to do your homework and make sure you're comfortable with that. So we never want to get you in a situation where you have to sell or can't sell. So because then there's a lot of pain.
We don't want to be in that position.
So because we've been around, we intend to be around for a while, so we want to make our customers happy. So another thing, the option 3, so we're looking at the third option, best alternative finance options right now is, I've seen 2-to-1 buy down rates. What does that mean? I've seen some of the builders do it. What does it mean and how does it work?
So a 2-1 buy down, just real simple. If your interest rate is 6.5% today, if the seller has provided enough in seller concessions or seller funds to pay towards closing costs, you as the buyer can work with your lender and utilize a buy down to where you'll get effectively for the first year 2% lower rate. So lock in 30-year fix for 6.5%. We'll use that example. You get 4.5% as your effective payment rate for the first 12 months. Second 12 months, it's only 1% lower. So now your second 12 months, you're at 5.5% for your principal and interest payment. And then on the third year, you're on your full 6.5%.
So that's some way you can use a credit from a seller to make it more affordable for 1 to 2 years. Now, keep in mind,
Well, you're qualified at
you have
the
to qualify
6.5%.
at 6.5, but you get the benefit. The seller is going to sell their property and get
So
you
if we
a
just
benefit.
talked about an ARM's going to adjust on you. This one, it won't go above 6.5%. So worst case scenario, what the end game, the maximum it could be is 6.5. So on an ARM, the maximum might be 10%. But the only way it would ever get there is if the economy, were to have a situation like we have right now, where the Federal Reserve is raising interest rates. That could drive up the ARM rate at the time of adjustment. So at least with the 2-1 buy down, you still have a 30-year fixed mortgage in the end. And in the short run, you can take advantage of savings. It could save you the money it takes to buy your blinds for the new home. There's a lot of things you could do with that savings. You could also apply it to your principal and actually really advance your payoff of the loan quickly.
Yeah. So that's another way that we see people taking advantage. So sometimes it's not better to ask for a lower price home. Sometimes it's give the seller what they want, but ask for some seller credit. So that's an advanced way.
It's a good negotiation tool.
Yeah, that you might want to look into to benefit you and maybe get some closing costs in addition to that. So that's something. Now the fourth way, I've seen it happen, but you got to have some friends and family that have some money. So we're talking about family members. So because honestly, someone that's older that has a chunk of change right now and the market's falter in the real estate market, they may want to lock in a 7% interest rate, correct? So they may want to do maybe a 10-year ARM or whatever. So how does it work from a lender perspective, having a family member basically be the lender? I know this doesn't benefit you, Brian,
It definitely
but
replaces me. So, but basically, you're just writing an agreement. So, what a mortgage is, there's a mortgage note. So the note is the agreement to repay, and that is paired with the deed of trust that's recorded as the transfer document, and it notates that there's a mortgage note against the property. So, in this case, you would have a family member write the agreement with you. They're probably going to want an attorney to help.
You have an attorney. Yep. So basically, you have a family member that's going to be your lender, and then you pay them. I have several recommendations. Make sure it's recorded. Don't be doing any of this. Make sure it's recorded against the property.
It's important it's recorded against the property because I had this come up recently where somebody had a friend that helped them finance the property. The friend used his own home equity line of credit to help them with the money, and they were going to refinance it in 6 months. Well, 6 months later, the rates were higher, and now they're having a hard time. But then they didn't record the paperwork. So now to get them approved, we have to now record the paperwork that was signed 6 months ago, and then wait before we can actually help them refinance into a more traditional loan.
So few things beautiful discussion there, but a few things is make sure it's recorded. I'd almost recommend that you hire a servicer. Absolutely. To make sure that the taxes are paid, particularly if you are the person holding the mortgage, because you don't want, if they're not paying their property taxes, to be foreclosed on and beat out. So you want to make sure you probably hire a servicer. The fees are very minimal. They make sure that the insurance is updated. They make sure that
they keep you compliant.
Safe and just do it like a regular transaction, even if it was a family member, because that's where I see things go sideways if we're not clear and record all the documents. So.
Yeah, keeping track of it on an Excel spreadsheet is not safe. Not a good idea in our professional opinion here.
Yeah, so
I'm going to throw one more at you.
Sure.
So what about seller financing? This keeps popping up from time to time.
That's an excellent one.
Are property sellers willing to take a loan?
Well, yes, particularly at 7%, right? I mean, 7%, try and get that in the stock market right now. So you can do, we've seen a lot of sellers do balloon payments. So it's kind of like an ARM, but what happens is that they'll do a 10-year at 7%, and it's a balloon payment at 10 years. Now, the danger of that is if things happen or if you're upside down in your house.
Well, in 10 years, you're going to have to work out that loan to something.
Yeah,
else.
So there is that overhang of it, but it's worth something to ask, particularly where we see it is if you live in a rental that the owner's owned it for 20 years, he may want to get out and not have to worry about doing a rental, worrying about all the things that go along with owning a rental. have you take that over, and he gets the 7%, and he'll hold the note, or he or she, sorry.
Yeah, and
So-
they might ask you to put a decent size down. So,
But you can find that out by asking us. We can find out from the title company if they own it outright, if they paid off their mortgage.
so in other words, if you don't have a rich uncle, maybe the rich seller could help you out.
And last year we had 3 different people take advantage of that, where they found a landlord that didn't want to do the landlord game anymore and just wanted 7% and do it for 10 years and then worry about it. So always that, this tough market, you gotta be looking into it. And that way you don't have to go through there's quite a bit of regulation still on Brian's side.
Any lending, this is why you have, attorneys help you write up, special contracts if you're going to do something outside of, say, a mortgage company, even if it's family, right? And same thing would happen in a seller carried mortgage like that. They would probably have their attorney write it up and work through the title company.
Yeah, make sure it's done legitimately, recorded,
Absolutely.
title insurance, do the whole thing. And if you have any questions, Brian and I always go to lunch with people, answer questions. Another thing is, if you're liking our videos, this one was a little bit more in depth, but we try and provide information that's useful for people out there right now, particularly since the market's changed and it's a tough time to either buy or sell right now. It's a
So
challenge.
if you need an insider, right, we got you. I'm your mortgage insider.
Yeah.
Ken's going to be your real estate guy.
Yeah, but like our videos, check us out on our podcasts. We're on social media. Check out down below in the description. We have links to all of our different sites.
Yeah,
And-
my website's homeloansreno.com. It's pretty easy. You can schedule a meeting. I think phone number should pop up for you. Can
Yep.
give me a call. Check out our
Put that on there.
website.
Yep, check it out and get in and talk to us. So,
Ken,
yep.
happy Thanksgiving.
Yeah, happy Thanksgiving. You take care. Till next time, you guys enjoy the holiday season, and we'll talk to you soon. Thanks.